Hey traders, as you know, cash secured puts only make money one way. The stock has to stay above your strike price and then you get to keep the premium. But what if I told you there's potentially a better way to do your cash secured puts? So today we're going to look at a seldom used strategy called ratio spreads. We're going to compare the two and we're going to see why they might potentially be a better option for your cash secured put trades. You're going to see why sometimes making a little bit less premium upfront can be a better option and potentially lead to a bigger profit. And also it's going to extend the break-even price on the downside without adding any extra risk to the trade. So let's take a look. Just a quick reminder that everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So let's jump over to Risk Navigator, and what we're looking at here is a cash secured put trade on PLTR. Pretty standard sort of trade, 28 delta. We're down at the 145 strike and around just under a month to expiration. We're generating about $525 in premium, and our break-even price here is at about 140. So you can see we've just got a flat profit line on the upside. That's the most that we can make, $530. If we plug that into our cash secured put calculator, we can see we've got a 47.5% annualized return potential if the put expires worthless, which is great. And we've got nearly a 10% decrease to our break-even price on the downside. So really good looking trade, pretty standard. This will be something that a lot of traders are kind of looking at. What we're going to do now is take a look at a ratio spread. So with a ratio spread, what we do is we actually come in a bit closer to the stock price and we buy a put. And then instead of selling one put, we're going to sell two puts. And you can see we've still only got one naked put. The risk on the downside is the same, but we've actually dropped our break-even price all the way down to 136.5. And we haven't sacrificed that much in the way of premium. Plus, we've got this nice little profit zone here if the stock does drop down into that zone between about 140 and 150. If we put that into our calculator, what we can do is we'll say it's going to cost us about $6.95 to buy the 150 strike put, and we're going to get two lots of premium of about, let's say 525. So our net premium is going to be about 355. You can see that there on the risk graph. That's our max profit potential above a price of 150. Now, if we compare that to our previous trade, we've still got a 31.5% annualized return potential, which is really good. We can ignore this decrease to our break even because our spreadsheet isn't set up for ratio spreads, but we can see it from the risk graph here that it's 136.5. So if I just override this value, we've actually got an 11.7% decrease to our break even. So we've sacrificed a little bit in terms of our annualized return, but we've gained on our decrease to our break even price. And we've also added this little profit zone here. If we think about an example of the stock finishing right at the strike price of 145, if we just sell that put option, we're going to make that $525. In this case, with the ratio spread, we're making over $800 in profit. So we've actually increased our profit zone if the stock has a little bit of a drop. So that can be quite beneficial as well, because a lot of times stocks do have that little pullback into that zone. Let's now think about a scenario where the stock has a really big crash or a big drop, which is the main risk with a cash secured put. Let's say the stock drops to 130. Let's have a look. The ratio spread is going to be down about $650. So price of 130, that's our expiration line, about 650. Let's have a look at just selling the naked put or cash secured put. We'd be down about close to 1,000, about 970, 980. So in most scenarios on the downside, we're going to be doing a lot better, even though we are still in a loss position in this example. And again, we're just sacrificing a little bit of premium on the upside. In terms of assignment, our risk is basically the same. We've still short the same strike. And if we've got this ratio spread, we're only going to get assigned on one because the long put here will offset one of the short puts here. So the maximum that we can get assigned is 100 shares with this particular trade. Now, you might get into a little tricky situation if the stock finishes between 150 and 140. And this one might get auto exercised at expiration. So you might want to make sure you close that out before expiration. And you might want to close one of the short puts as well if you're in that scenario where you're in this zone here. So just something to watch out for. Again, it's a pretty small risk, not something that you really have to worry about, but have a plan just in case that does happen. So ratio spreads are a little bit more complicated. So it does require a little bit more experience, but I think you can see that this might be a great alternative for your cash secured put trades. If you want to reduce that break-even price, sacrifice a little bit of premium, but potentially have a little bit of extra profit in this zone as well. So let me know what you think. Is this the type of trade that you might be willing to try out in the future? Let me know in the comments. So thanks for watching. If you found the video helpful, please remember to like and subscribe. Reach out anytime with questions and have a great day.